President Trump just signed the big, beautiful bill into law, and the White House is claiming that 88% of retirees will no longer have to pay tax on their Social Security benefit. So in this episode, what I want to do is I want to break down some of the key provisions in this tax bill, and particularly how it will impact people who are in retirement or who are nearing retirement. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. Before I dive in, I have to give you a warning. This is going to be my least professional video ever. There will be no editor, and I'm recording it on my laptop at a dining room table using my laptop microphone because I am on vacation and I planned on not doing a video this week, but I knew that with the signing of this new bill and the passing of the final version of the tax bill, there was going to be a lot of conversation about this bill, and I wanted the opportunity to weigh in. It's a giant bill. There's a lot of controversy on both sides of the aisle. It's over 900 pages long. The final version of the bill was passed rather quickly because President Trump wanted to be able to sign it by or on July 4th, which he was able to do. Some of the provisions in the bill are very specific to certain subgroups of people. For example, tax on tips. And then there are really interesting things like there's a $50,000 deduction for whaling equipment. Why $50,000 for whaling equipment? Because they desperately needed the vote of the Alaskan Senator, Lisa Murkowski. There are also some other interesting provisions in the bill, like they lifted the tax on silencers for guns, which is great for mob bosses because they may have a harder time collecting gambling debts because the bill is going to reduce the amount you can deduct for gambling losses. There's a lot in this bill. There's the social impact. Most economists believe that lower income families are going to be hurt because they will believe it will cut Medicaid benefits and SNAP benefits, which is the food aid program. Now, the White House pushes back on this and says that's not true. Those benefits are not going to be cut. I will leave those questions to other analysts who have had much more time to read the bill than I have. In this video, I want us to zoom in on one thing. What does this bill mean to people approaching retirement or in retirement? So I want to spend the next few minutes breaking that down. First, one of the biggest things about this bill, or one of the biggest components of this bill, is that it keeps the status quo. As you know, during President Trump's first term, he passed the Tax and Jobs Cut Act of 2017. But those tax cuts were set to expire at the end of 2025, so taxes were set to raise next year, and it made tax planning really tricky because we had no idea whether the tax cuts would be extended. Now we know. These cuts have been made permanent. In Congress speak, that just means they're not set to expire, but they could always be changed by another future Congress. This bill also includes an increase in the standard deduction. In 2024, the standard deduction was $14,600 for single filers and $29,200 for married couples filing jointly. In 2025, those numbers are going to increase slightly to $15,750 for single filers and $31,500 for married filing jointly. But here's the big deal for retirees or older Americans. Starting in 2025, anyone who is age 65 or older will get an additional $6,000 deduction per person. But here's the catch, and it's a fairly significant catch. This deduction only lasts from 2025 through the end of 2028. And so at the end of 2028, it's going to go away unless it is reauthorized. And it starts to phase out once your income exceeds $75,000 if you're a single filer and $150,000 if you're married filing jointly. This, by the way, is where the White House gets the number that 88% of people will no longer have to pay tax on Social Security benefits. Nothing was changed about the tax on Social Security, but the higher standard deduction means that most people on Social Security will owe less in taxes. Now, the next provision, and this is going to impact me personally, is raising the limit or the ceiling on how much you can deduct of your state and local taxes. Before 2017, you could deduct whatever you'd paid to your state and local government. You could deduct that amount from your federal taxes. In the 2017 tax bill, to help pay for it, they put a limit that you could only deduct $10,000 of state and local taxes. This was a big sticking point in the negotiations in this bill and is one of the things that almost ended up sinking the bill. They finally settled on raising the cap from $10,000 in 2024 to $40,000 in 2025, which is a significant increase and is especially going to help high earners in states like California and New York. But like other provisions in this bill, it is temporary and it expires in 2029 and it phases out for high-income households. So if you earn between $500,000 and $600,000 of income, the benefit begins to disappear pretty quickly. And then if you earn over $600,000 of income, the benefit disappears completely. And so that means proper tax planning is going to be really important if you live in a high-income tax state. Next, if you give to charity and take a standard deduction, which most people take a standard deduction today, and that number is only rising, if you take the standard deduction, you can't deduct what you contribute to charity. Well, there is a nice added bonus in this bill for those of you who both claim a standard deduction and you give to charity. Starting in 2026, if you notice, these things are all over the place. Some things start in 2025, some things start in 2026, some phase out in 2028, some phase out in 2029. So you've got to pay attention to exactly what happens when. Starting in 2026, you're going to be able to deduct charitable donations, even if you take the standard deduction, but there is a cap. It's $2,000 a year for married couples and $1,000 a year for individuals. Now, this, unlike a lot of the other changes, it is permanent. So if you do not itemize, this gives you a way to support causes you care about or to give money to your local church or synagogue and still reduce your tax bill. Next, in the category of surprising deductions or just rather odd deductions, starting in 2025, there is a deduction for car loan interest up to $10,000 a year. So in the same way that you can deduct interest on your home, now you can deduct the interest you pay on your car up to $10,000 a year. But there are some catches or some caveats. First, the car must be new. You can't get this deduction on interest on a used car. Second, it must be for personal use, not business use. And third, it must be assembled in the United States. If you meet all three of those provisions, then you can deduct $10,000 a year in interest that you pay on a new car. Now, this deduction phases out on income above $100,000 a year for single individuals and $200,000 a year for married couples. And again, this provision only goes through 2028. Next, legacy planning or estate taxes. If you are thinking about legacy planning or you have a fairly significant estate, starting in 2026, the estate and gift tax exemption jumps to $15 million per person for an individual and $30 million per couple. Now, it's not a giant increase from the current levels, but if you remember, those levels were set to expire at the end of 2025 and decreased significantly. And so in addition to increasing the level slightly, it makes the higher levels permanent in the same way that the other things are permanent, right? A future Congress could roll back this law, but it is not set to expire in the same way that the current exemptions were set to expire. Here are just a few other things to know. The child tax credit is going to increase to $2,200 a year for any kid under the age of 17. That starts in 2025. The energy efficiency tax credits, those now are going to go away at the end of this year, so the end of 2025. So if you were thinking about upgrading a heat pump or something and wanted to get a tax credit for that, you have until December 31st, 2025. Now, this is important. If you were thinking about buying an EV, those tax credits are now going to end September 30th of 2025. So they go away completely September 30th, 2025. That's on the used vehicles and new vehicles. So if you were thinking about buying, whatever EV people are buying these days, because I know a lot of people on both sides of the aisle no longer are having with Elon and with Tesla. So I don't know what people are buying these days, but if you were planning on buying an electric vehicle, you have a pretty short window to buy that electric vehicle within. The bottom line is the current tax rates are going to be made permanent, and we're going to see a higher increase in the standard deduction, and we are going to have a much higher SALT cap. And so this is going to provide an opportunity to eke out a bit more tax savings for older Americans. And so if you were thinking about taking IRA distributions or realizing some long-term capital gains or doing Roth conversions, the next few years are going to be important because you have a window that you can do so in a slightly more tax efficient manner. Okay, I'm going to leave it there. I'm going to get back to vacation. I have a couple new videos coming out over the next couple of weeks. And if you haven't seen my video on why you maybe shouldn't do a Roth conversion, right? A lot of people think they need to do Roth conversions. Well, I have a video on why you shouldn't do Roth conversions, and you can watch that now.